Guys, welcome to Breaking Chart Alerts Options Intro Trading class on YouTube here. We're going to be getting started shortly. Class is going to start right around 10 a.m. here. I'm going to be going over calls, puts, options, and part of our trade plan here and how to find entries, exits, targets, and stops. And this is going to be a beginner's course here. If anyone has any questions, you guys could let us know in the chat, and I'll be looking at that at the end there, and we could go over any Q&As that you guys have. So we'll be getting started shortly, and be ready in about 5 minutes. Alrighty, guys, about another 2 minutes. We're going to get started here. I just want to make sure everyone is here, ready to go. It will be recorded too, but it's probably going to be edited and will be added to the channel probably in about a week. But about another 2 minutes, we're going to get started. And along the way here, guys, if you guys have any questions, just please, if you're on Zoom with us, go to the Zoom chat. And if you guys message there, I'll look over things at the end there or throughout the sections I'm going through. And I can go over any Q&As you guys have. Good morning, Juan. Alrighty, last minute countdown, guys. Good morning, Juan. Good morning, Alex. Good morning, guys, on Zoom with us. Good morning, Elena. I think you're new. Nice to have you with us. LaFlash. Good morning, guys. Hope everyone's having a great morning here. Alrighty, guys, it is now 10 a.m. I want to get this class started here with you guys and not ruin the rest of your holiday weekend here. So today's class is going to be an intro to options trading. Okay. I'm going to be going over a key few things here with you guys. Number one is we're going to be going over, the basics of options. What are options, strikes, expiration dates, how we're going to find those strike prices, those expiration dates, what are calls, what are puts, and then, we'll save the advanced strategies for another class here. But this really important class, especially for those of you that are new with us at Breaking Chart Alerts. I want to go over our trade plan briefly as well here. And then also what I'm going to be doing is I'm going to be posting in the trade room here an hour-long class of our detailed trade plan. I'm going to go over it briefly with you guys today. But I have a very good detailed class just on the trade plan I'll be posting in the trade room as well. But let's get started here. And if you guys have any questions along the way here, please use either the Zoom here chat or the YouTube chat, and I will get to those questions either at the end of the section or at the end of the video. We'll see how things are going. Alrighty. So first things first, guys, I'm Dave Santarelli from Breaking Chart Alerts and Santarelli Trading Exchange. Get the presentation started here. So welcome to our options trading class, obviously. We're going to be going over the basics of calls, puts, and our trade plan here, and more precisely, how to find the right entries, exits, targets, stops, strike prices, and expiration dates. That's really important, and we're going to be going over all of that in today's class. Let me just make sure you guys could see everything before we're going. Okay, that looks good. Alrighty, let's get started here. So again, I'm Dave Santarelli. I've been trading full-time for about 15 years. I created the Santarelli Trading Exchange. I created BreakingChartAlerts.com, and I created the Breaking Chart Alerts app that you could download on the App Store for free. All right, I developed the Breaking Chart Alerts website. So what we do at Breaking Chart Alerts is we teach people how to leverage their money. Instead of buying shares, they can buy options. Okay, we teach them our specific trade plan. We trade live together, and we have a great option community, the app alerts we sent out, the text alerts, and we teach people how to properly trade, how to manage risk, how to be disciplined, and how to follow a trade plan. And that's the most important part of being a trader. Okay, so obviously you guys know that this class is to introduce you to trading options and investing in options here. Investing involves risk, just like anything else. Don't be foolish and start trading without knowing what you're doing. There's too many people that start trading and they have no idea what they look for. They lack a trade plan, they lack discipline, and they let emotions play a big role in their trading. And it's really important to follow a trade plan when trading. There's too many traders that come to us and we ask them, what is their strategy now for trading? How do they find trade setups? How do they find their entries, their exits? And they have no idea. They just say, hey, we're just going to go along with it and we'll take profits along the way. Well, I'm going to teach you a precise trade plan that shows you entries, exits, and that you could follow on a daily basis. Because what we're going to be able to do is we're going to be able to swing trade and do some day trading as well. At the end of this video here, I'm going to give you guys an opportunity for a free membership at Breaking Chart Alerts to try it out. Okay, so you guys know the difference between stocks and options, okay? So stocks are basically a fractional ownership of a company, okay? That's it. An option is totally different. It's a contract between two people, okay? So let's go over this. Simply, all that an option is a contract between a buyer of the option and the seller of the option. One option controls 100 shares of stock. It's really important. I'm going over this presentation now, and then we're going to dive in to like a little workshop type of session here, and we're going to go over it on the eTrade Pro platform here We're going to look at the option chain and we're going to dissect it really in detail here. First, I want to go over this presentation. So again, an option contract is simply an option between the buyer and the seller of an option. One contract gives you control over 100 shares of stock. You have the right, but not the obligation, to buy or sell that stock by that strike price at that expo date. Okay, so the strike price is the specified price. There's a couple things you need to know with the option. Obviously, we have our strike price, we have our expiration date, and then we have the strategy type. Okay, so the main thing with the option contract itself is the strike price and the expiration date, and then the premium that you're paying. And then we could go over the strategy based on our trade plan of, are we going to get a call? Are we going to get a put? Are we going to get a vertical spread, a strangle, a straddle, an iron condor, a butterfly? There's so many different strategies. But for right now in today's class, we're going to focus on calls and puts. Okay, so a strike price. There's three categories of a strike price. And I'm going to put this on the other screen here for you for a second so you could actually get a look and see what it's looking like. So let me change over to this other screen here. So as you can see, the strike price is the price you agree to buy or sell that option at. Okay, there's three types. There's an at the money, meaning you're getting a strike price that's where the stock is currently trading at. For example, if we look at Qs right here, let me get up one sec. Let's see, 151. Okay, perfect. Now I'm going to share this screen with you here. So you see the strike price. Okay, you have an at the money, in the money, and out of the money. Now let's go to this screen right here, and I want to share this with you guys. So the Qs in the background right here, you see this is a 3-month daily chart right here that we're looking at Qs. Each one of these candles represent 1 day. Okay, so if we're looking, there's 3 types of strike prices. All right, so today's date is what, the 2nd, April 2nd. So let's take a look at the April 9th. As you can see right here, this is the April 9th, 2021. The stock Qs here, this ETF is trading at 325.30 a share. Okay, so an at the money strike is going to be that 325 strike. So here's your strike prices. Here's this option chain. Here's the puts to the right, and here's the calls to the left. Okay, so an at the money strike means that simply we're getting the strike closest to where the stock's trading at. This is really good if you're looking for a longer term trade, 30 days plus out till expo. Or if you're looking for a safer trade, you could go in the money. You know, if you're going in the money, there's already value built into that contract. Because, for example, if you pick up the 323 strike call right here, you know, there's already $2.30 of intrinsic value in that, you know, which is value that's built into that strike price because the stock's higher than that strike price right now. Okay, so if you want a lower risk, you go deeper in the money because the stock has to drop much further for you to lose money as it pulls back there. So if you're going with an at the money, that's the one I usually go at for 30 days or less till expo. If you're going further out, then you could start getting an out of the money or an OTM, like the 327, maybe even the 330 strike if you're going out to that June 18th expo. But again, the main thing here that I want you guys to focus on is that there is 3 types of, put this on here, there's 3 types of strike prices. You have the at the money, the in the money, and the out of the money strikes. So what strike you're going to get is going to be dependent on how you're looking at that chart. And we're going to be analyzing these charts soon here once I get to the charts here. Let's just finish up with this presentation here. So now we went over the strike price. Okay, like I said, there's 2 major things, finding the strike price and finding the expiration date. The strike price, are you going to go with an in the money, at the money, or an out of the money? Expiration date, you got to decide how long you want to hold that contract for. It's a regular contract. Think of it as a contract between you and a lawyer, or you buying a house. Whatever expiration date, it's the close of trading on a specific date. The 3rd Friday of every month is a normal monthly expiration. There's a lot of ETFs and a lot of stocks that trade on a weekly basis as well. But it's important to make sure you're looking at the open interest and volume, which we're going to be going over as well in a minute here. So when you're focusing in on expiration dates, number one major thing is giving yourself enough time for that trade to go in your favor. And we're going to be going over that and analyzing how you could tell how far out you have to go for that expiration date for that stock to hit your target resistance or your target profit area. Okay, so for example, let's go back to the screen here. Expiration date is the close of trading on a specific date. Monthly options are the third Friday of every month, weekly options, and there's even daily options on SPY. Okay, now the price of an option contract, this is the premium paid. This is the fee or the cost of the contract. It's the deposit for you to have the right but not the obligation to own those shares. But you can sell the contract anytime to Expo. So even if you pick up that June expiration, you could sell it tomorrow. Well, obviously not tomorrow, it's Saturday. You could sell it on Monday. You can sell it any time from now until expiration as long as the markets are open. So it's always good to have that time on your side. And I'm going to be going over in the main account some of the trades that we made for that July Expo here. And I'm going to show you where we're at with our trade plan and where we're going to be adding to those trades now, because it's really important to be looking at those longer term expos, especially now when we have most of America now is getting the vaccine. I think there's about 150 million Americans that have received their doses, their second doses. And if you guys just read about the unemployment numbers that just came out, we're at 6% unemployment now. That's the lowest we've seen in quite some time, since the pandemic started. Also, we have new jobs for the month of March. I think it was 915,000 compared to 675,000 that were expected to be added. So the numbers are getting better. The economy is getting better. Businesses are picking up and things are looking much better for the economy. And that means the stock market as well here. And we're starting to get that climb and that bounce here. So back to this. Price of an option is the fee of that contract. You don't have to sell it at expo date. You could sell it at any time. And we were going over the intrinsic value, ITM or OTM. Intrinsic value has money built into that option premium. Extrinsic value is also known as time value. So if you go out for the July Expo, obviously you're paying more money for that contract because you're paying more money for that time compared to if you got something that expires next week, where you only have 5 days until expiration. So the price of an option, that's your premium paid. And we're going to be going over that on a live example here. All right, so now there's two types of strategies. So first off, what is an option? You guys know what an option is. It's a right but not the obligation. It's a contract to buy or sell a stock at a certain price at a certain expiration date from now until the expiration, anytime in between. Okay, now a call option, you're going to be making money as that stock goes higher. You control 100 shares of that stock for a fraction of the cost of the shares. Now, perfect example, let's take a look here at the Qs once again. So the Qs right now, if you guys see Qs, so with an option, you control 100 shares of that stock. So if you just came here and bought 100 shares of Qs at 325.30, obviously 100 times 325.3, that's going to cost you $32,530 to buy 100 shares of Qs. Right here, if you pick up the Qs, all you're going to be paying for is, let me pull this up here. So let's say you got the April 9th on Qs, right? For next week's expiration. You got an at the money strike call for 325. Okay, so all this is going to cost you for control over 100 shares of stock is $322. It's $3.22, but right here you can see there's 100 shares per contract. So you have to multiply that by the premium paid. So it'll cost $322 to control one contract of the Q April 9th 325 strike call. That's not bad. You're controlling 100 shares of this ETF for only $322. Whereas if you bought 100 shares of Qs right now, it's going to cost you $32,530. So your money is much more leveraged trading options. Now, here's the nice thing, guys, that I want to show you. Why do you want to trade options over shares of stock? Now, here's why. If you bought those 100 shares for $32,530, right? Where do you need the stock at to make a 100% return? Obviously, 325.3 times 2, right? So 325.3 times 2. So you would make a 100% return on your 100 shares if Q's got to $650.60. But guess what? With options, your money is much more leveraged and you could take advantage of a swing in that stock and have incredible returns. Now, watch this. Now, what is our break even on this option contract right here? Everyone always asks me. So, if you guys are new to options and you're saying, I don't understand what any of this means, take a look right now. So, all this means is you have the right but not the obligation to buy Q shares at $3.25 a share, right? For that option, you're going to pay $3.22. So your break even on any type of option trade, a call or a put, well, on a call here, it's going to be your strike price plus premium paid. So here, 325.00, that's your strike, right? Let me do this on my desktop here. It's going to be easier for you guys to see. Okay, so 325, that's the strike price, right? Plus premium paid. So 3.22. Well, that 3 looks horrible there. Okay, so now 325 plus 3.22, that equals, so 325 plus 322 equals 328.22. That equals our break even. Okay, so 328.22, that's where we break even on this contract, right? So let's say, you could see right here, Qs were up $6.17 on Friday, right? You see that move right there, up almost 2%. So if she goes up another $3.22, that'll bring us up to, we said 328.22. So that means that 325 strike is all what? It's all intrinsic value. Plus, we'd have some time value as well. So it would be worth even more than that. But our break even is strike price plus premium paid. So 328.22 is break even. Now, where do we have 100% return at? 100% return is going to be that break even plus premium paid. So another 322. So 322. Let me just get the calc to make sure we're doing it. 328.22 plus 3.22. So at 331.44 equals a 100% return. So that's what's really important here. And understanding with options, you only need this stock to climb by what? About another 2%, another 2% climb from now until April 9th, and this is going to make a 100% return. Now, let's say we wanted to calculate, what if Q's got to 330, right? So let's say right here, you're looking at this and you're saying, well, what if by April 9th, it gets up to 330? What's that going to be worth? Well, if it gets up to 330, that's the current price, right? 330 equals price and then minus strike of 325. That equals $5, right? So if you paid $3.22 or $322 for that contract, it's now worth $5 or $500 a contract. Now, let's say we have a big move in the market next week and we see Qs at, let's say, 340 by next week, right? 340 minus that strike of 325, that's 15. If we paid $3.22 and it's now worth 15, 15, divide that by 3.22. That's a 366% return if Q's got up to 300 and what did I just say? 340 by next week. So if she got up to 340, that means that 325 is going to be worth $15. You paid $3.22 for it. So that's the importance of understanding here the break even and what a call is. So a call, you're going to make money as the stock goes higher. Your break even is going to be your strike price plus what you paid. So again, example here. So your break even, guys, again, is your strike price plus premium paid. So 325 strike plus 322, that equals a break even of $328.22. So if Q's at your expiration date are at 328.22, that means you broke even. You didn't make money, you didn't lose money. Now, we usually never hold on to options until expiration. What we're doing is trying to sell them quick. You know, we want to do a quick swing trade, a day trade, and I'm going to show you with our trade plan now how that's going to work out. But first off, that's how you do the break even, calculate that, and then how you calculate that 100% gain. 100% gain is always going to be break even plus premium paid. Okay, so now what I want to do with you guys quick while I have you guys on here, I'm going to give you an example and I want you guys to tell me what is the break even and where's the 100% return. We're going to do a nice little workshop here right now and I want you guys to do that with me. So let's clear this out right here. I'm going to put up something else here and I want you guys to calculate it. We'll do it together. Okay, so let's take a look here first at a stock. We'll look at Facebook. Okay, so Facebook, we'll look at the April 9th that expires next week. Let me put the Facebook chart in the background here. Okay, so Facebook's in breakout momentum. We actually have a nice breakout. We consolidated back down to that 10, and now we're breaking higher again. We have resistance at 300 and then another one at 310. But right now, what I want to focus in is we retraced down to that 10, held that support, we started that breakout. So here's a perfect example of a short-term opportunity on Facebook to capture a week trade here from now until April 9th and just look for a couple more green candles above previous candle's body for a big return. And as you can see on this option chain right here, you can see on the left again is the call side, on the right is the put. You can see the open interest and total volume I was talking about earlier with you guys. When you guys are trading options, the most important thing is to always look and see that there's enough open interest and total volume. And when I say enough, I'm saying if you're getting 10 contracts or less, you want at least 150, 200 contracts in volume and open interest at least, okay? If you only see a couple here and a couple there, you're not going to get filled and you're going to see that bid and the ask here. It's going to be much wider than, like here, for example, it's 670 by 690. It's only a 20-cent spread between the bid and the ask. If you don't have that volume here, it might be $6 by $8. And that's huge here. That's a, 25% difference between the bid and the ask. So always look, always do a limit order, and always make sure you have the volume. But now getting back to this example here, let's say we wanted to pick up the 300 strike. We're going to make this really easy for you guys. So the April 9th 300 strike call, it's going for $4.07. Now, I want to know from you guys, what's our break even? Okay. If anyone wants me to take them off speaker here, I'm going to take you off speaker. Let me know on the Zoom chat, and I'm going to take you guys off speaker. What is the break even, and where is the 100% return at? If it's trading, last traded at $4.07 a contract. Let's see, where is Josh Ellsworth? Let's see if I can get him on here. Or you know what? Let's see Teresa here. I'm going to unmute you, Teresa. Let's see if you could come on quick here with us. Are you there, Teresa? Hey, how are you? Awesome. All right, so could you see this Facebook example we're going over now? All right, so our break even now, what is going to be our break even on this contract, on this call contract?
break even is going to be 304.7.
304.07, right. So strike price is 300. That's the strike. Plus, we'll initiate it PP, premium paid. So plus the 4.07, and that's how she came up with that. 304.07. That equals our break even. Now, Teresa, where would we have a 100% return on this option with Facebook?
Okay, so let's see. The premium we paid was 4.07. So we need to add that to the break-even price, correct?
Yep.
308.07 for 308.14 to have
308.14. That is correct. 308.14. If Facebook got to 308.14, that equals a 100% return. Okay, so every time that you're going to be making a trade, whether it's with us at Breaking Chart Alerts or yourself, now I want you every time you make a trade is to calculate this. Say, where's my break even? Where do I make 100% return? Because what most people don't understand and don't realize about this, and you'll see this with a lot of beginners, especially those trading options here, is they think let's say Facebook, perfect example here. They think Facebook's going to get up to $305. That's going to be the resistance, right? Let's just use this as a hypothetical situation here. So let's just say we have, Joe Schmo coming off the street, just started trading options, and he doesn't have any clue of how to find those target profit areas, target resistance, or stop areas. So he's coming in, he's saying, okay, I think Facebook's going to get up to $305. That's a $5 climb from where it's at right now, another 1.7% climb from where it's at. I'm going to jump in these options. Well, guess what? If you only think it's going to get up to 305, where that resistance is, and then retrace once hitting that resistance, well, guess what? If it gets up to that 305, hits resistance, pulls back there within your expiration, let's say it happens, let's say it gets up to 305 on Monday, and then it struggles with that 305, and on Tuesday she's back at 300. Well, guess what? If you have that 300 strike call, you needed it at 304.07 just to break even. So if you think it's going to get up to $305, why the heck are you going to get a trade for the 300 strike, pay $4.07 for it to make 93 cents? That wouldn't make sense. That's why it's really important now. Now what we're going to be jumping into is, now we went over what is a call, what are the strike prices, the expiration dates, what are we looking for? Now we want to go over how do we find and utilize these calls here with our trade plan to find our target profit areas and our stop areas. Because the one most important thing with traders is that discipline to follow your trade plan, follow your targets, follow your stops, and make sure you keep the emotions out of trading. And that's the biggest thing that I see with new traders is they let their emotions involve a big part of their trading. Because here's what's important that you guys don't realize here is that with hold on one sec, I hear some other stuff in the background here. There's a few of you that have your things unmuted. Okay. Oh, sorry, let me get you off there, Teresa, again. Hold on, here we go. All right, are you there?
Yes, we have a few questions in the chat box. I think let's go with this section right here before you move on, if you wanted to check those out.
Okay, sure. Let's see here. Israel Felix. Let's see here. All right. This info is gold. How do you pick which option, which price point you choose? Is it based on technical breakout, target stops, volatility numbers, IV, or other Greeks? I think how to choose the which option is difficult, and I have a hard time picking which option to buy. That's coming from option T. Well, option T, you're going to be amazed at what I'm going to show you right now, because now I'm going to show you the trade plan. And like I told you guys before, I'm going to give a copy of the trade plan in the trade room as well here. But this is how you calculate your strike price and your break evens and your 100% return. So now what I want you guys to remember is always do this before you make a trade. Because if you say, okay, here's my break even at 304.07, and I just think Facebook's going to get it to 305, obviously that's not a good strategy. That's not a good trade to make. You'd be silly to make a trade like that. So make sure that you're looking at these strategies and calculating these. And with options, you could really quickly and easily see where that break even is, where that 100% is, and where the stop is. Okay, so I want you to do this on every trade before you make a trade. What's your break even? What's your 100% gain at? And where's your stop at? So our stop on this Facebook trade, obviously with a trade less than 2 weeks out till Expo, what do you guys say? Where's our stop? And I guarantee you someone in this Zoom chat that is a member of ours is going to know. What is the stop on the Facebook trade with it being the April 9th Expo? What candle are you looking for there? Let's see who types it. Okay, 50% max stop loss. Yes, but specifically, what candle are you looking for to close out that position? What candle? The first candle with the red body below previous candle's body. So, for example, right here, Facebook, if Facebook is still breaking out like this, if the candle looks like this is breakout momentum, right? That's what we're looking for. That's where we want to capture that quick little swing trade, sell it up here, have that 3-day run, and then look at that. In 3 days, we just closed out a profit. Huge here. And I mean, if she got up to here, this is what's really nice about calculating this. So take a look at the size of these candles right now on the chart in the background, right? You guys could see the size of these candles and the run it had. So let's just say it does get up here, the upper end of where we have it. What's that price there that we have? Let me see. Annotation. Let me see. Undo. Okay, so if it did get up to that right here, let's say that 308, right? So if it gets up to 308, that's 100% return. And you see that it just moved, 10 points in 2 days on Facebook. So think of this. If Facebook got to $310 from now until April 9th, that 300 strike is going to be worth $10. You paid $4.07. So you paid $407 for one contract. If you've got 10 contracts, it's $4,007. So just so you know, if it's one contract, that's going to cost $407. The premium paid plus the 100 shares per contract. So this is what's nice about Facebook. You picked up that 300 strike. You think she's going to that 310. Well, guess what? If she has another, 10-point climb like she just did on Thursday and Friday, she has another 10-point climb by Tuesday there. Well, guess what? That 300 strike is now worth $10 of intrinsic value plus time value of extrinsic value. So it's worth at least $10. If you paid $4, 10 divide that by 4.07, that's a 146% gain there if she got up to 310 plus time value. So it's going to be even worth more than that. But let's get back to the trade plan now, because here's the thing. How do you find your expiration dates and how do you find your targets? And this is what's really important, because a lot of people, they get short-term trades, when there's volatility in the markets and there's choppiness in the markets, and you can't do that. So let me show you now. All right, let's go to Qs here. So here's a perfect example of Qs, right? I look at this chart right here of Qs. So you guys remember what happened last year, right? Right around February, March of 2020. What happened? The coronavirus, right? We had a big pullback here, right? Now, obviously, we just went over calls, okay? So I didn't go over the puts yet, but puts, you're going to be making money as the stock drops lower. Calls, you make money as the stock climbs. Puts, you make money as the stock drops. So right here, what we're looking at with our trade plan, and who asked this question right here? Let's see. Okay, option T. How do you pick the option? How do you pick the price point? How do you pick anything? What do you do? So watch this now. So with our trade plan at Breaking Chart Alerts, I'm going to make it sound really, really simple, and it is, but it takes years to getting like this. So we look for 3 targets here for an entry. So perfect example right here is number one with our trade plan. We're looking for that. If you see the three lines here, that yellow line, that is the 10-day SMA. The blue line is the 20 SMA. And the red line here, that's the 50 SMA. And SMA just stands for simple moving averages, okay? So again, what's really important here is understanding what are these three lines, okay? First off, I always have hollow candles on my background here. That tells me everything. It tells me where the stock opened, where it closed, where the highs and where the lows were at for the day. And that's very valuable information. So always hollow candles, okay? This is on a daily chart, which means each one of these candles represent one trading day. Now, if I put it on a today 1 minute chart, then obviously each one of those candles represent 1 minute, what the stock did in that 1 minute. So now that you know what these lines are here, the 10, 20, and 50-day simple moving average, now what we're going to be doing is using these for our entries and our exits, part of them. So when you want to buy a put, you need 3 check marks for entry. Okay, so 3 check marks for entry. Now, what are those 3 check marks, guys? Number 1 is the 10 crossing below that 20-day simple moving average. So here's that yellow 10-day moving below that blue 20-day. There's check number 1, right? SMA cross. Second one, the MACD, the moving average convergence divergence. You want that signal line crossing below that MACD. Here it is right here. Okay, so the MACD. Then what you're looking for is first red candle below the 10 and 20 SMA. So here are your 3 check marks that you're looking for. 1 is the SMA cross. 2 is the MACD cross. Number 3 is that first red candle below the 10 and 20. Well, here's the 10 and 20, right? Where's that first red candle after the crossover? Well, that's going to be right here, right? So right here is your entry for that put. So if that's your put entry right here, that's where you're entering. Now, obviously with a put, you make money as the stock goes what? Down, right? So as the stock goes lower, you make money. Well, guess where your stop is with our trade plan? Your stop is going to be that first green candle above, with body above the 10-day simple moving average. So right here, that is your exit. Now, the nice thing about it is you could calculate exactly what that made here by backdating the test here on the option chain. You could go back here and you could test exactly what that was at on that day at that time and then what it was at here. This kind of move right here made you well over a 200% gain. So there's your entry, there's your exit. So that trade right there, you could already see that trade took about, let's see. So if you had your entry on February 27th, you had your exit on March 24th. So about a month, a little less than a month, and you locked in that big gain there on that put. And that's what's really important because too many traders, they think they got to trade every day. They think you gotta make multiple trades every day. With trading, you really have to have a strategy and a trade plan for success. You have to be disciplined to follow that trade plan, and you have to keep your emotions out of trading. Because think about this: if you got into it right here on that entry, well, guess what? 3 days later, 4 days later, you're probably down about 40% on that trade, 30%. I'd say probably 20, 30% on that trade right here. If you got in on the 27th and then 1, 2, 3, 4 trading days later, when she got up to that 10-day simple moving average and tested that resistance, then started to fail. Well, guess what? You're down, a good 30% on March 4th here. But guess what? On March 5th, you're probably only down about 10%. And then on March 6th, you're probably up about 20%. On March 9th, you're probably up closer to 50%. And as you continue to drop there, those gains continue to climb. Now, that's how you make money on the put. Now, guess what? So that's where you close out that put right here on March 24th, right? Now, with our trade plan, when the stock's trading between that 10 and 20 SMA, that's considered a no trade zone. That's an area consolidation. So during this time right here that you're seeing, right here, that is NTZ. That's what we call it with our trade plan. NTZ means no trade zone. This is also known as consolidation. Okay, so now you just made a nice profit from that cycle right there. That's called the BDM, the breakdown momentum cycle with our trade plan. You just had a nice profiting on that drop there on those cues, right? Now you exited the trade on that date. And now what you're doing for the next 1, 2, 3, 4, 5, 6, 7 trading days is waiting for that to give you that next signal. And now what's that next signal? You guys know what the signal is now for the breakout momentum, right? Breakout momentum. So for a call, and we're going to say BOM, that stands for breakout momentum, equals 3 checks for entry. Okay, so now here's the nice thing about a lot of people say, what type of expiration do you get? Well, first off here, number 1, you're looking for that 10-day crossing above now that 20-day. So there's check number 1, right? SMA cross. Now, number 2, the MACD already crossed back here when it was in no trade zone or consolidation. So you have your check mark there. MACD cross. Now, number 3, guess what that is? The first candle above the 10-day and 20-day simple moving average after those 2 crossovers. So there's a cross, there's a cross. Where's the next green candle above the 1020? That's right there. So there's your entry. Now, guess where your exit is? Your exit's going to be that first red candle below the 20-day simple moving average. On breakdown momentum, you're using that yellow 10-day as your target resistance, where she's getting up to resistance and then failing and heading lower. And then it got into the no trade zone consolidation. And now when she's breaking out, you're using that blue 20 as your stop. Just like here, how you were waiting for that first green candle above that 10-day simple moving average. Now on the call side, you're waiting for that first red candle with full body below that 20-day simple moving average as your stop to take profits. Now, a lot of people ask, first let me put, so the third check is the first green candle above 10 and 20 SMA on a daily chart. Make sure you're looking at a daily chart. Okay, so now guess what? Here's your entry right here. What's that date? Your entry right here is on April 6th. Where do you see that first candle with the body below this blue 20 SMA? Right here, you could have one right here, but you have support at 250. Now, first things first, what expiration are you getting? So you have 3 cycles really with our trade plan. You have breakout momentum, which you're buying calls and vertical spreads for on the upside as the stocks climb. You have breakdown momentum, which you're buying puts and put spreads on the downside. Okay, and then you have your consolidation or your NTZ, your no trade zone. And that's the time that you're staying away from trading there as she's trading between consolidation there. So that's what's really important there is understanding that. Okay, so now that you have those calls. 3 check marks for entry. You're looking for that 10 crossing above that 20 SMA. You're looking for that MACD cross, and you're looking for that first green candle above that yellow 10 and blue 20-day simple moving average on a daily chart. So right here on April 6th is our entry. Now, here's the thing. When you have that new cycle forming, here was the breakdown momentum where you profited with the puts. The stock staying below that yellow 10-day simple moving average, that's breakdown momentum, you're trading puts. Now, when you get that 10 cross and above, this is a signal here that you have some buyers coming in and that you have a sign of a reversal coming off those lows. So this is really important. When you get that first crossover, especially on the Qs, Diamond, or SPY ETF, what you want to do is something 6 months out till expiration. So right here on your entry on April 6th of 2020, get something 6 months out. October of 2020. Okay, that's 6 months out. So if you have October, that's 10, right? So 10, October 10th is all the way up here. Yeah, I mean, she got to 300, you know? So here's October over here. October, she's still at 300. So you get something with 6 months out till Expo when you get that new cycle forming. That's something where if you don't have much time to manage your trades, these are the types of trades you want to focus on. I mean, this is what's really extremely important here is knowing that if you have time issues, if you don't have time to be in front of the computer all day, you can't be doing this stuff all day, then look for those longer term trades. When you get a new cycle formation here forming, you know, on that April 6th there that we were just talking about, when you got that entry candle, look for something 6 months out. And then every day, all you have to do is at the end of the trading day, say, hey, do I have that red candle below that blue 20-day simple moving average? If you do, you take in profits and then you wait for that next trade. You know, so that's something if you want longer term trades for. So a lot of people say, how do you find some longer term trades? How do you find shorter term trades? Well, this is how we find those longer term trades is by analyzing the charts here, finding that initial crossover, that initial new cycle of breakout momentum for Qs on example that we're going over now. And that's what you're focusing in on. 6 months out till Expo when you got that new cycle that just formed. And here's that new cycle right here, guys. I mean, this whole cycle right here is breakout momentum. I mean, that's entire breakout momentum. That's the breakout momentum cycle. So with our trade plan, you could take advantage of that and make money in that whole cycle here as she continues to climb with our trade plan. Now, here's the more little bit disciplined part of trading. Okay, let me clear this out here for you guys. So that's what you're looking for as far as cycles are going and with entries, exits, you're going in. So when you have that first 10-20 cross, that's when we're going with an at the money strike call. So here's your 10-20 cross. Here on April 6th was your entry. So if the stock was at, 195, for example, right there, you're buying that 195 strike call for the October monthly expo, 6 months out till expo. You're not selling until you get that stop there of that first red candle below the 20. And guess what? From 190 all the way up to that sell signal of 255, that is a massive, that's over a 400%, probably closer to 600% return right there in that short amount of time there, just from your entry to that exit signal right there on that candle on July 24th there. So that's extremely important there to follow that trade plan. So option T, that's how you're looking for those longer term trades. That's how you're looking for and analyzing what expiration you should go for. Now, here's the thing. What about those short term trades, right? Perfect example. Let's look at Qs on a 3-month daily basis right here. All right, I want to share this with you guys because this is really important what I'm going to share with you right now. Okay, so right here you can see this is all breakout momentum cycle, right, on Qs. So this is all breakout momentum. This is the breakout momentum. We initiate that bomb, BOM. That's the breakout momentum cycle. That's where we're trading the calls at that entire time. Now, guess what? Here's that 10 crossing below that 20. First candle's below that 10-20 SMA. You're out of that trade. If you're in over here, you're out right here. That's your exit signal. Here's your entry, 10-20 cross. First green candle above 1020 after the MACD cross. So here is your entry. Here's your exit. First candle below that, 20. So that's your exit. Now, guess what? She's in breakdown momentum for a while. Here's the breakdown momentum cycle with our trade plan. After that 1020 cross, there's that breakdown momentum. And then here's that first candle above that 10-day. And now guess what she's doing now? So here's a perfect example of the 3 cycles of our trade plan. So this is considered the NTZ or consolidation. So now what's really important for you guys to understand is during this green cycle here, this is the area that we want to be buying the calls, the vertical spreads, buying shares, whatever we want to the upside. When we're getting that 1020 cross, this is where we want to focus in on those puts and those short-term, vertical put spreads and whatnot like that. So what's really important, now take a look what happened here in this yellow box, NTZ. Now remember, each one of these candles represent one trading day. You guys know that have been members with us, that for the past week, we really haven't been making as many trades. And there's a reason why. When you're looking at the general market, Qs are a great indicator of what tech's going to be doing or what tech's doing, right? So what's really important with this is saying, okay, well, if Qs are trading side by side here within consolidation, well, guess what? Facebook, Amazon, Google, that means those probably aren't going to be climbing, right? They're going to be consolidating as well. I want the market in my favor for me to get something, a trade. I don't want to be making a trade when the markets are choppy or when we're trading in consolidation. That's silly. Theta is going to eat away at that option premium, and theta is simply time decay on that option premium. So, for example, if you have a theta of 10 cents, that means every single day that option premium is going to decrease by 10 cents of value because you have one less day until you get closer to that expiration. So that's why it's always important, number one, get enough time on your side. There's too many people that think, hey, they want to swing for the fences and they're getting short-term expos for 30 days or less out till expo, and that's going to devastate your account because if you get one big pullback there, you don't have enough time. Like if you have a week out till expo and you're in breakout momentum like right here, well, guess what? This one red candle here, if you only have a week till expo, it took you 4 days just to try to get back up to where it was before the drop. Now that option's expired. It's worthless. But if you had 2 more months, well, guess what? 2 months from now, you still didn't get that sell signal because you still don't have that first red candle below that 20 SMA, and now you got a profit on that trade, all because you went with that longer time frame there. And that's what's important with going with that longer time frame. But what's most important, guys, is this. During that no trade zone, stay away from trading. Look for volatility. That's when you could be day trading. Now this box here, you have resistance. So here's resistance at 320, and then you have support at 310. So 310 is support, 320 is resistance in this consolidation box. So what I always teach our clients and our members, once we break out of that NTZ or out of that consolidation box, that's the time for a short-term trade up to that next resistance. Well, what's our next resistance area? Well, take a look. It's right here. It's clear as day at 330. So if this stock's at 325.30 a share now, I could say, hey, you know what? I'm okay with picking up some Q calls for next week's expo, having that 330 as my target. Once she gets up to 330, guess what? I know exactly what my option is going to be worth by using the delta, theta, and the Greeks of options. So if I picked up that 325 strike call for $2.30, let's just say $2, make it even. So 325 plus $2 at 327 is my break even. At 329, I have 100% return. And at 330, it's well over 100% return. Now, here's what I always tell you guys, because too many people, like for example, let's go over a trade we have on Disney, a perfect example here. We got a Disney trade. First off, let me show you guys something here. So here is what we did on Friday. Let me just get this up here. So here's what we did on Friday. On Friday, we picked up some Google, we picked up some Qualcomm, we had some nice gain. We're up $7,000 on Friday alone. That was a nice gain there. But I want to focus in on this trade right here that you can see, this Disney July 16th 190 strike call, right? 190 strike call for July 16th on Disney. We picked that up, right? We got a nice $1,000 gain on that for the day. But I want you to see the option chain on this for now, because a lot of people, sometimes they'll get shorter term expos and that really screws them over. So take a look here on Disney now, and let me show you what exactly we did with Disney and what we're looking for with Disney. Because obviously with the theme parks opening up, airlines are taking off, theme parks are doing well. Now take a look. So we got into a Disney trade probably back in March, when she started breaking out above 200 bucks. Honestly, this is probably right where we entered into that Disney trade, right? Now, we got Disney for 4 months out until Expo. March, April, May, June, July. 4 months out till Expo when we picked up this Disney trade. Well, guess what? It went against us for a while, and now we started adding to that trade. She's holding that 50 SMA. She's starting to climb. It's got its first candle above that red 50 and yellow 10-day simple moving average. Now, if we could break that short-term resistance right here at 190, I'm going to be adding another $10,000 to that Disney trade, and I'm going to be targeting that 200 to 210 area for the July Expo. Obviously, as summertime gets closer here, you're going to got a couple of things that are going to be making some sense for you guys, okay? So number one is you guys are going to be having a lot of the vaccine rolling out. So as the vaccine rolls out, more people are getting vaccinated and everything's starting to get back to normal. That's number one. Number two, as you guys saw this morning, unemployment numbers are at 6% now. That's stellar numbers compared to what we've been of, close to 20% during the pandemic. So 6% unemployment rate's really great here. The other one, the new jobs that were added in the month of March, 917,000 jobs compared to they were only expecting to add 675,000 jobs in the month of March. So things are looking good. Think of it as a test paper, Everything's starting to check off here. Everything's looking good. We got the economy growing. We got unemployment dropping. We got businesses opening back up. More people are getting vaccinated. Things are looking much better now. So now you're seeing the charts like Disney here start to continue to climb. This is a perfect opportunity. If you're not in a Disney trade right now, she's bouncing off of support right now with our trade plan off of that 50 SMA and holding that 185 support. That 185 is in a critical support area right here that she's been going back to since January of this year. Okay, so now that she's holding above and climbing above that 10, you could have a target of 195 easily, 195 to 200. And if you wanted to do a short-term trade on Disney, you'd be looking at something like at least the June Expo here. It's April, May, June, 2 months out. Now take a guess. If she gets up to 190, if you pick up that 190 strike for $10, 190 plus 10, $200 is your break even. Now, if she gets up to $210, that means that 190 is going to be worth $20. You only paid 10 bucks for it. That's a 100% return. And you have from now until June 18th for Disney to get up there. And guess what? If she just gets a quick climb next week up to 195, you could calculate what this is going to be by going here, going to the option chain, adding your delta. So a delta is going to tell you for every dollar that Disney goes up, how much is this option premium going to increase in value? So if you picked up that 190 strike for 10 bucks a contract, it's telling you right here that 190 strike has a delta of 0.516. So just for, just to look, Disney was up $4.33 on Friday, right? So let's just say that Disney goes up another $4.33. To calculate what this option is going to be worth, all we have to do is take what we're expecting the stock to increase by. So let's just say on Monday, Disney increases by $4.33. So 4.33, multiply that by your delta. Your delta on that 190 strike is 0.516. So 4.33, multiply that by 0.516, and that means this option contract is going to increase in value by, let me get up my annotation here. So that 190 strike is going to increase by $2.23. So plus $2.23. So if you paid $10 for that contract, she increases by $2.23. Well, guess what? That's a 22.3% increase, and that just made you $223 per contract just by having that 4-point move here. And guess what? That only costs you $1,000 to control 100 shares of Disney compared to, that $18,885 it costs you to buy the 100 shares. So this is what you're looking for. If you're looking for a short-term swing trade, say, okay, here's my next resistance area. I always like to say R1, R2, and R3. I always like to have R1, R2, R3. That's your target resistant 1, target resistance 2, target resistance 3. So if it's a shorter term trade, you're looking at that R1. If it's 30 to 60 days out till expo, look at that R1 to R2 as your target profit area. And then if you have something that's 90 days or higher out till or further out till expo, look for that R2 and that R3 target profit area. So that's how you find your target resistance, your target profit areas. Here, for example, your target profit area is going to be between 195 and 200. This is your target for a short-term trade on Disney. Now, the nice thing about it, when we send out our trade alerts, at Breaking Chart Alerts, obviously here, when we send out our alerts here, you just go up to trades, you can see trade alerts, and now you're going to be able to see exactly when we send out a trade, even if you don't know how to trade, now you know the basics here. So you could go to one of our trades here, Google breakout momentum trade, right? You can pick this up here. We'll look at the Microsoft trade. So here is our target. Here's our stop. It gives you the current price. It gives you the implied move for 7 days. Our break even. Where do we have 100% gain at? Where do we have a 200% gain at? When is the earnings? And then we also like to go over the catalyst. Why are we jumping in that stock? Now, what I just went over with you guys, this is all the technical side of trading, okay? This is all the technical side of trading and, how to find your targets, how to find your stops. And obviously your stop right here is going to be a strict 185. So 185 equals your stop area. So if that stock drops below 185, you're exiting out of that trade, which is a tight stop. It's at 188 now. So you have a $3 stop compared to a $12 climb to your target 2 resistance area. So that's how important it is to understand that risk to reward ratio on your trade setups here. Find something with a tight stop and that's got some room to run to that R1, R2, R3 target profit areas. So now you guys learned how to find your strike, what is a call, how to find your break even, how to find your 100% gain. And what I told you to now, what's really important is, like I said here, is the discipline of trading. Because right now, you can see Disney had what? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. She had about 3 weeks of just pulling back here. Well, guess what now? Now, if we have that strength from the economy improving and everything else going on, she's going to continue that run back up to that 200. So if you have a longer term call now that doesn't expire until July, like we have, for example, well, now when she breaks above that 190 or that blue 20 SMA, that's when we could average down on the trade or make a new trade for a shorter term expo and then ride it up to that 200 resistant target profit area. And that's what's really important, is following a trade plan. And the nice thing about it, with Breaking Chart Alerts, I'm giving you guys everything here. We send out the app alert, we send out the text alert, we send out the email alert, we post it on the website. There's 4 ways right there, plus the trade room. There's 5 ways. Plus the live trading. There's 6 ways that you could look at our trade alerts. And it tells you everything, our target, our stop, what we're looking at. Here's the break even, here's the 100% gain, and the catalyst. Why are we getting into that trade? Because you can't just get into a trade for no reason. You want supply and demand to be an issue, because obviously if there's more demand for that stock, then that stock's going to continue to climb and break higher. So it's really important to make sure that when you're starting to break out there, don't take profits too early. Watch your targets, watch your stops. And what's really nice here, let's say that you wanted to jump into a Disney trade right now. Well, if you have a good brokerage account like E-Trade Pro here, let's say you have a target of 200, a stop of 185. This is all you have to do. Type in Disney, and guess what? Say, I want to be alerted when this stock is above $200 a share or when she's below 185 a share. Now, you could put a notation here. This is my target and stop areas. Now, when you click OK, well, guess what? You just made that trade on Disney, and you're telling E-Trade, hey, tell me when she drops below 185, because that's my target stop area. If she drops to 185, I'm out of that trade. If she gets up to 200, that's where I'm taking profits. So now when you click OK, bam, that trade alert is done. And now E-Trade is going to either send you a desktop notification, a text alert, or an email alert when that Disney either hits 200 or 185. So you could really set the trade and forget it, which is really nice. So when you get our trade alerts there, that's all you have to do. All you have to do is go there, make the trade if you're following along, and then you could put in your alerts there with your brokerage account. But now going back to this now is taking a look here. So here's your retracement period. You know, you have that big breakout. I always talk to our members about that. Here's that 1020 cross. Here's the MACD cross, first candle above. And guess what? She continued to break out. Here was your exit on that long-term trade at 173. And you got in that trade at right here at about 140. So from 140 all the way up to, 170, what do we say? About 173, 174. That's a big move there with those options. That's a massive gain there. Okay, so now you can see what she did. She retraced, came back down to that red 50-day simple moving average, right? And then what happened? She retraced right down to that 50, and then she started that climb again. Climb, dropped back down to that 20, started that climb, back down to that 20, started that climb. Now look where she's at again. She's holding that 50. During this whole breakout momentum cycle, there's been one thing that's been in common. And you have to be like a detective here when you're looking at these charts because it's really important. It gives you all the clues that you need. You could see that she's been using that red 50-day simple moving average as support. She comes down to that red 50, holds it, and then starts that climb. Comes down to that 50, it held it, now it's starting to climb again. So here's a perfect opportunity to have a $200 target on Disney and trade it up there. It's at 188 right now. So from 188 to 200, that's a 12-point gain that you could capture and make a quick gain on Disney. And like I said, with spring break here, with everything reopening, everything's really amazing and continuing that breakout there. So keep that in mind. And we are well over our time here, and this iPad is almost ready to die. So let's wrap things up here. Let me go over one more thing with you guys here. So now what I wanted to show you guys was, so again, take a look here. That's what we're looking at here. So you see we have a couple of different of trades open. Qualcomm, Google, Disney. We have a Bank of America vertical spread there. These are what's important. Looking at these strategies and looking at the expiration dates. You can see most of my trades here expired June or July of this year. You know, there's one thing that expires, April 16th here. That's Express. That really didn't do much. But most of my trades here are for June and July Expo. If you're getting shorter term trades, you're trading the volatility in the market, and there's a good chance those options are going to be worthless by the end of the day. And there's a really good chance of that. So it's really important to understand that and realize that you have to go with those longer time frames for your trades there, especially when you're in consolidation for a while. Okay, now let me get back to this screen share here. I kind of did everything in the workshop just now, but I want to finish up this this call option there. We just went over that. So perfect example here, as you guys can see on the screen right now, is here's what a long call looks like. So perfect example here is, let's say you bought that 100 strike call here. So you can see right here, this is a 100 strike. Your break even is your strike price plus premium paid. So as you can see, here's your strike price. As you get higher, let's say 102.50, this is right between 100 and 105. So this midpoint right here is 102.50. I could already tell you that 100 strike means that this contract costs $2.50. So $2.50 plus the strike is 102 break even. So you can see now how as you start to go from loss up to profit, now once you get above that break even, the profit is unlimited as the stock continues to climb here. So that's what's really important about giving yourself enough time on that option, is giving it enough time to continue that climb. If you only give a stock 1 week to do what it needs to do, obviously, after that week, you can't capitalize on any returns there. So if you give yourself a few months out till Expo and she continues that run, your profits are unlimited as the stock continues to climb there. So always give yourself enough time on those trades. Now, a put option. A put option, you make money as the stock goes down. You control 100 shares short that stock for a fraction of the cost of the shares. And same thing, strike price, expiration date. And then here's an example of the put. So they put on here A on this. They forgot to put the price point, but obviously, as you guys can see here, as the stock drops, you start to make some profit as the stock drops. As the stock goes higher, you lose money. The max you could lose is the premium paid. Now, you guys know why we're trading options, right? You're leveraging your money. Perfect example, Disney, 188.85 a share. If you got, 100 shares of Disney times 188.85, that's $18,885. You're tying up $19,000 to own 100 shares of Disney when you could buy a contract for $200 and control 100 shares of Disney. Okay, same thing here. You got leverage. You're controlling 100 shares. One share of Google is $2,300 when I made this. 100 shares of Amazon is going to cost you $340,000. Whereas if you bought that one contract and controlled 100 shares of Amazon, it might only cost you about $1,000. You got security, you got insurance because you're not using as much as your capital, and you can control risk because you're following a trade plan. And that's what's most important about trading, is following a trade plan and being disciplined and being patient and having the audacity to adapt to that trade plan. You pull back for a couple days, well, guess what? If you come down to that support and you start breaking out off that support, that's where you want to add to that trade. Now, combined with shares, you got a lot of strategic opportunities here. Combined with shares, you could sell some covered calls. You could get paid to wait for your price, and that's going into advanced strategies there. But I'm going to save the advanced strategies for another class. But I made another presentation for vertical spreads, butterflies, condors, straddles, and strangles. But we're already in an hour and a half here, so. What I wanted to give you guys now is the opportunity to come join us for a free trial. If you guys have stayed with us, I want you guys to come here, and you guys could see right here. Let me pick this up. You guys could go right here. Go to our website, 30% off. Use promo code ClassPromo30, and you guys could use that and get signed up right there. So I hope you guys enjoyed this class. It's recorded. I'm going to edit it and post it on the website. If you guys have any questions now, I'd like to go over some questions really quick. I got about 8% battery left. So if you guys have some questions, let's zoom down here and we'll start right now. Let's see, Sergey says, thanks, Dave. How much theta would you focus on? Theta is just time decay is real. So, obviously you're looking at it, if you're seeing that you're losing at least 10% a day in theta, then it's not a good option to get into. So if you pay $1 for that option premium, you see it has a 10-cent theta, that means it's losing 10 cents per day. So in 10 days, it's going to lose that $1 and be worthless. So anything more than 10%, I'd stay away from. That means theta's eating away too much at that option premium. Okay, how do you determine whether or not the price premium is good price? That's a great question, Karen. The whole point of that was looking at that target. So anytime you enter into a trade, perfect example like Disney, you're saying to yourself, does it make sense to enter into this trade? And for Disney, for example, let's say you're looking at next week's expo for a run up to, 200, let's say. Okay, let's use the April 16th for example, 2 weeks extra. Okay, so if you pick up that 190 strike, it's going right now for about, that's actually really cheap. Theoretically, it's saying it's going for about $1.90. If you pick that up for, let's just say $2, break even's 192, 194, you have a 100% gain. So if your target is 200, guess what? If you pick up that 190 for $1.90, she gets up to 200. That means that 190 is going to be worth $10. 10, divide that by 1.9, that's a 426.32% return. 426% return if you pick up that 190 and she gets up to 200. That's how you're analyzing that. Because now if you analyzed it and, for example, at 200, you're going to make a 10% gain. Well, you know what? For moving 12 points and only making that 10% gain, that's not worth it. When you're looking at an option, I want you to be focusing in at least a 75% gain on trades that are longer than 2 weeks out till Expo. Shorter than 2 weeks, look for that 25 to 50% return. That's what I want you guys to be focusing in on. And with our trade plan, I'm going to share the details of the trade plan. I have a very in-depth, detailed trade plan video. I'm going to post that. Ephraim's actually going to post it right now in the trade room for you guys. And if you guys just watch this class right now, watching that trade plan video is going to help you tremendously. All right. So I hope that helped you guys out. I really enjoyed these classes. What I want to start doing now is I was thinking Tuesday and Thursday, we could do a quick 15-minute video after the market closes, maybe around 7 o'clock. We could go over our current trades, what we're looking for. That way, everyone's on the same page. Everyone knows what we're looking for, what we're doing. I think that'd be nice. A little trade recap on Tuesdays and Thursdays. And then we could have our classes on Wednesdays. So that way, Tuesday, Wednesday, Thursday, we're busy. And then Fridays are day trade Fridays. And Mondays, obviously, we let the market, do its thing and watch and analyze the market conditions. So if you guys enjoyed this video and you're watching this on YouTube, please give it a thumbs up, give it a like, share it on social media for us. And if you guys enjoyed this class, please let me know, because if you guys did, I'd love to do more of these. So in the chat on Zoom, let me know what you guys thought of today's class, and let me know what you guys think. Let's see. Tony says, what membership doesn't include training on reading charts? So the yearly membership there, which is only $1,750 now. It's normally $2,500. We have 30% off, so it'll be $1,750. That'll include. Let me get it up here for you guys. So that'll include the Elite Trader. To use that, use promo code challenge or the one that we just gave you, Elite Pro Trader. Sign up, and then as you guys can see, it brings it down to $1,750. What this includes, first off, if you pay $250 a month, that's $3,000 for the year for the Pro Trader. You're already saving $1,250 by going with the Elite Trader. The difference between Trader and Pro Trader is a Trader, you have the morning live trading. That's it, and the live trade room. Pro Trader, you have the live morning session, live afternoon session, and then Elite Pro Trader, you also have the education tab here, which is all of our classes, our lesson libraries, and then our private classes, as well as our app. You can download our app, our trade plan, all of our videos, advanced, intermediate, beginner classes, the live trade room, live morning, live afternoon, and everything else. And then obviously, if you guys want the newsletter, you just go up to home, go to the newsletter. Every single day we send out our newsletter, the top stocks that we're watching for that day, top stocks and everything that we're looking out for that day. So for example, here's March 31st. Markets closed today, so there's none today. But here's March 31st. Here was the top upgrades, downgrades, target changes, top news, the top stocks we're watching that day, and then of course the earnings in the morning and then after market hours. So it's really important always to be looking at this and understanding, why are we doing what we're doing? And at Breaking Chart Alerts, all you have to do is go to that home page, go down to that newsletter, and then you'll see the newsletter for that day. And a lot of our members love to print that newsletter out, analyze each of these stocks that they see here, and then the stocks to watch, follow our trade plan, and it's really simple. And what's really great is if you go and join us, you go to live trade room during the day, and then we got a ton of members here that are going. Ephraim just posted our trade plan video in the trade room for you. So if you guys get signed up, make sure the first thing you do is go here, click on that, and here is going to be that trade plan. Here's the class right here for you. This is a really great trade plan video for you guys to watch. So make sure you guys get signed up. Go watch these classes here. It's really great classes for you guys. and it's very detailed. So check that out. And if you guys have any questions, just let us know, and we'd be happy to have you with us. And any questions, you guys could click us on Messenger right here. And let me see. So again, just shoot us a message here on breakingchartalerts.com. Log into your messenger, shoot us a message. And if you have any questions, just let me know, guys. You guys can connect with me on Facebook, anywhere you guys want. Again, my name is Dave Santarelli from Breaking Chart Alerts and Santarelli Trading Exchange. And I hope everyone had a really great day today. Had a great class, and I'm really looking forward to next week. I think the markets are going to continue to break out here. We got strong numbers and economic numbers coming in here, along with the unemployment numbers and with the vaccines rolling out. I think we're going to continue to climb from here. Looking forward to those gains. And if you guys need help, please feel free to shoot us a message, and we'd be glad to help. Alrighty, guys, take care. Have a safe and happy Easter. And I will see you guys on Monday. Take care. God bless. And thanks for joining. Bye-bye, guys.